Hey, everybody. This is Scott Dyreng here. It's great to be with you on the LinkedIn Live sessions that Fuqua has been running. I have been a professor at Duke since 2008. And unlike most people in the world, I think I was born with a genetic defect which caused me to enjoy taxes. And so this eventually led me to a PhD in accounting and a set of research studies that examine tax avoidance and specifically corporate tax avoidance. And so this is a fun opportunity for me to talk about some of the stuff that I have studied and thought about over the past 12 years that I've worked at Fuqua. And it turns out that there has been a flurry of excitement with regard to taxes, both personal taxes and corporate taxes, in the United States and internationally over the past 5 or 10 years. In fact, if you go back to the Obama administration, there was bipartisan support for corporate tax reform. The Obama administration had proposed a reduction in the corporate tax rate from 35% to 25%, and a 20% tax on foreign profits with something that was labeled as no deferral. And that reform was never enacted because, in large part, bipartisan or sort of partisan disagreement over personal taxes. The Democrats, generally speaking, wanted to raise personal taxes to cover the costs of reducing the corporate tax, and the Republicans did not, so no agreement was made. It turns out, as many are aware, at the very end of 2017, the Trump administration passed what is now known as the Tax Cuts and Jobs Act. And it was a sweeping tax reform, the largest since 1986. And on the corporate side, the major provision was that the corporate tax rate was reduced from 35% down to 21%, so a 14 percentage point drop. And the corporate tax on international income was essentially reduced to 10.5% from what it was 35%. And there were other modifications as well to corporate taxes that included things like a different way of dealing with interest deductions, net operating loss carryforwards, depreciation, and many other kind of nuanced characteristics. But the major thing that happened was that the statutory rate for corporations was reduced from 35% down to 21%. And then it turns out, because the Republicans controlled Congress and the White House, the personal tax side of things went in a way that was probably not possible during the Obama administration, which is that personal taxes were also reduced by and large. So today, I don't want to focus on personal taxes. Instead, I want to think about corporate taxes. And as you might imagine, if the statutory tax rate is reduced significantly from 35% down to 21%, it would make sense that corporations' effective tax rates, or in other words, the burden that they actually faced, how much tax did they pay relative to their income, also would have declined. So what I want to do is just share real quickly with you a figure from a new study that I have, which is just something that I'm working on currently. And what this figure shows is it's a plot of the average firm's effective tax rate. The effective tax rate is the amount of tax that you paid relative to the amount of earnings that you had. And if you look at the dark blue line at the top, you see this sort of declining trend. And then in 2017, what's labeled transition year, there's a spike up. And then after the transition year, where we have labeled TCJA, Tax Cuts and Jobs Act, you see a significant fall in the GAAP effective tax rate. The reason there's a jump up is when you're looking at GAAP effective tax rates, what you're really doing is you're not looking at the cash that was paid to the government, but you're looking at an accounting number that's related to tax expense. And during the first year of the act, companies had to, in some cases, record a lot of expenses which were not actually paid to the government. That causes the blip up, but then going forward, you see the drop. If you look at the red line, which is dashed, a lower line, you'll see that there's not a blip up, but that the actual cash burden, and this is the amount of cash that was paid in taxes relative to income, declines significantly with the TCJA. But of course, one of the things that happens when you look at a line like this is you're just simply looking at the mean. And with any mean, there is a large distribution around that mean. And as you can see in this figure here, this is an older figure that the New York Times published in about 2012. But it shows that the average company at this time was paying about 29%. But some companies were paying something like almost zero. That would be those companies towards the left. And some companies were paying well above 35%, which at the time was a statutory tax rate. This fact, the fact that there are many companies that pay a lot of tax and many companies that don't pay hardly any, has been a troubling thing for many think tanks and commentators. And so almost every year for the last 10 or 15 years, different entities will produce lists of companies that have paid little to no tax every year. So just quickly, I grabbed off the internet a list of companies that in 2018 did not pay any US tax, even though they were profitable. And top on the list you'll see there is Amazon. And Amazon in 2018 had about 11 billion in profit, but actually didn't pay any tax at all. In fact, they got a refund, at least federal tax. And these types of headlines often arise as newspapers are writing about corporate taxes. Well, now we have entered into the presidential election cycle, and the process is coming to an end soon. And during that process, there have been a number of proposals made by the current administration and also by the Biden campaign. And it's particularly interesting to think about what's been proposed by the Biden campaign, because what the Trump campaign wanted to do has essentially been enacted. So if the Biden campaign wins and President Biden becomes the president, and especially if the Democrats win control of the House and the Senate, I think it's very likely that some of President Biden's proposals would be enacted. So what are some of the things that President Biden has proposed? Well, the first thing is the Biden administration is proposing to raise the statutory corporate tax rate from 21% to 28%. So if that were to be done, what one might expect to see happen is something like the following figure. If you recall the figure that I showed you earlier, which you can see here, maybe. Sorry, get this thing to flip. What you can see here is I have, in very sophisticated fashion, drawn what I think would happen if the Biden administration were to win the election and their proposals were enacted. What I think you would see is the rates would increase relative to where they are now, but not quite as high as what they were before the Trump tax cuts of 2017. In other words, the rate used to be 35%. It was reduced to 21%, and we saw a big drop. And then if we were to raise it back to 28%, naturally you would expect the average company's rate to increase, but not back to the level that it was before. The next thing that the Biden administration has proposed is that there was a new tax called the Global Intangible Low Tax Income Tax, which has an amazingly long name, but a brilliant acronym, which is called the GILTI tax. And the GILTI tax was designed to cause companies that have large foreign operations and pay very little tax in foreign countries, companies like Apple or Google or Facebook, It was designed to compel them to pay US tax on their foreign income to the extent that they were not paying foreign income. And that guilty tax rate in the Tax Cuts and Jobs Act was set at 10.5%. The Biden administration has proposed doubling that rate to 21%. If that were to happen, US firms would almost certainly pay more US tax on their foreign income. And then a third proposal, and this proposal is designed to eliminate or at least shrink the list of firms that have zero taxes in any given year. Biden has proposed to introduce a minimum tax on financial accounting earnings. If this were done, any company that was in the situation of, say, for example, Amazon, like I showed you earlier, that had earned 11 billion and reported 11 billion in profits to their shareholders, but paid no tax to the US government, would enter into an alternative taxing regime in which they would pay 15% tax on their financial accounting earnings. And this tax has become known as the Amazon rule. So let me talk to you a little bit about this proposed tax so that it's easier to understand exactly what's happening. I'll share my screen once again and provide that illustration to you. So in 2018, Amazon reported US pre-tax profits, according to financial accounting standards, of 11.1 billion. But it reported that it received a refund from the federal government of 129 million. Now, that refund is an approximation because what companies are required to report is not the actual cash taxes that the government sent them, but something that's very highly correlated. So we don't know exactly if it was $129 million refund, but it was very close. The question is, how did Amazon manage to report 11 billion of tax, or sorry, 11 billion of profits to their shareholders and yet not pay any taxes? And the answer lies in the way that restricted shares that's given to employees are recorded for financial accounting purposes and taxed by the government. So Amazon is very well known for giving a wide spread of its employees restricted shares when they begin working for the company. Well, it turns out that financial accounting under generally accepted accounting principles and tax accounting are different rules. And as a result, a company can end up with different numbers. And let me show you how that works. This is a simplified example, but it illustrates essentially what was happening at Amazon. Suppose in January 2015, Amazon grants restricted shares to an employee. The price of Amazon shares in January 2015 was about $300 per share. When the company grants these shares to its employees, it will record a compensation expense of $300 per share that it issues. But it will get no tax deduction for those shares because the government doesn't like to give deductions until the employee actually has control of the shares. But because the shares don't vest for a number of years, in year 2015, Amazon will get no tax deduction. Fast forward to 2018, and let's suppose in 2018, the restricted shares vest, giving the employee the right to use those shares in whatever way the employee wants. The price of Amazon by 2018 in December was about $1,500 per share. When the shares vest, Amazon will record no expense for financial accounting purposes, which essentially means that its income would be higher than you might have expected because the expense had already been recorded back in 2015, so nothing has to happen. But it turns out the government will now say that Amazon can take a tax deduction for the fair value of the shares when they vested, which means Amazon will get a $1,500 tax deduction. The employee likewise, will receive compensation worth $1,500 and will pay personal taxes on the $1,500. So the key takeaway is the following. In 2018, Amazon will have very high income because it will have not reported any compensation expense, but it will have very low tax expense because it will have a very large deduction. The result is that its tax paid will be extremely low and its income will be high, giving it an effective tax rate of something like 0. Well, this is interesting because Amazon, in a situation like this, has done absolutely nothing illegal. They really haven't even done anything aggressive insofar as tax avoidance is concerned. All that really happened was their share price went up dramatically, which gave them a much larger tax deduction than they otherwise would have had. The Biden tax, which has become known as the Amazon tax, would prevent this from happening by taxing the $11 billion that was reported using generally accepted accounting principles at 15%, in addition to any tax that may have been incurred under the traditional tax system. Now, I would imagine as I have gone through this, you might have some questions, and I would encourage you to write any questions that you have in the comments section while I make a few more comments. And then for the last 10 minutes or so of our session, I'll be happy to answer those questions to the extent possible. So let me just briefly make a comment on the idea of taxing financial accounting earnings. At first glance, this seems like a logical thing to do. It seems like if companies can report profits to shareholders, we should tax those profits. But a more careful examination of the facts suggests that this might create some unintended consequences. So here's something that might happen. If companies know that their financial accounting earnings will be taxed, it might lead them to make accounting choices which push the boundaries of accounting rules and make their reported earnings look lower than they otherwise would be. The second issue is that if Congress recognizes that financial accounting rules are being used to tax companies, Congress might be tempted to dictate what the financial accounting rules are. Why is this the case? Because the two different systems, financial accounting and tax accounting, have different objectives. Financial accounting is designed to provide information to investors so that they can more efficiently allocate their scarce investment resources. Tax accounting, on the other hand, is designed to raise revenue, encourage or discourage certain types of behavior. For example, we tax cigarettes because we think that that's maybe not a good thing, but we give tax benefits to companies that invest in renewable energy. So that's another purpose of tax. And then the third purpose might be to redistribute wealth. Because they have such different purposes, financial accounting and tax accounting have evolved as separate systems. If we start taxing financial accounting, the fidelity of the system of financial accounting might be jeopardized, at least to some extent, because of those reasons. The Congress might be tempted to meddle in financial accounting, and companies might be tempted to distort their financial accounting to reduce their tax bills. All this is to say, the proposals that the Biden administration has made are interesting. I think that they would definitely have an effect on corporate tax burdens, and they could possibly have fascinating consequences that go beyond the simple raising of tax revenue and affect corporate behavior in possibly unpredictable ways. Okay, at this point, I'm going to take a minute and answer a few questions that have come in. One is from Mani Setharaman, who is a Fuqua alum, PhD student that we had here several years ago. And he asks, will there be any double taxation of Amazon income because of the Biden proposal? So the short answer to that question is we don't know for sure because the details on these proposals are almost always extremely scarce. My suspicion is that only companies that report below a certain threshold on their tax income would be subjected to the financial accounting income. It would be like an alternative minimum tax. And so that would be designed to reduce, I believe, double taxation. So my guess is the answer to your question is no. Brendan Bolander, one of our current MBA students, asks, he said that accountants pretty much universally agree that taxing financial accounting earnings is bad. I believe Brendan is saying that because I probably said that in one of my classes previously. Do you see any good alternatives to tax companies like Amazon that would be more acceptable? Or do you think that it's not necessarily, as mostly a matter of adjusting public perception? So the answer to that question is complicated. So corporate taxes are tricky in many ways. One thing to think about is a year in the life of a corporation is sort of an arbitrary period of time. Last year, next year, 5 years from now, the company might be paying more tax than the statutory rate. And if you think about the figure that I showed you, where I showed the distribution of firms' effective tax rates, you'll notice that some of those firms were paying at rates much higher than the effective tax rate. And the question is why? And the answer is because of the discrepancies between financial accounting and tax accounting, some of those discrepancies are timing issues, which lead a company to have very low taxes in 1 year, but then very high taxes in a future year. And in Amazon's case, once the share price stops increasing 300% every year, which we all expect will happen, these unusually large tax deductions will disappear. So it makes for a very controversial headline in the current year, but in the future year, when Amazon might pay a higher rate, it probably won't make any headlines at all. So at some level, I do think it's a public perception issue. That's not to say that there aren't things that could be fixed with the corporate tax system, but it is to say that in many instances, companies get a lot of grief for essentially following the rules that were created by Congress and were set up in a way to encourage them to behave in a certain way. Let me just add a little bit more context to that. So last year, the New York Times published an article about FedEx having paid no tax, but reporting a lot of income. And the question is, how did FedEx do it? And the answer was FedEx purchased a large number of airplanes, delivery trucks, and other things, which gave them accelerated depreciation deductions sufficient to offset all of their tax liability. The ironic thing about the article was that the government, by enacting accelerated depreciation, did so with the purpose of encouraging companies to invest in equipment, in buildings, and other types of projects. And they encouraged them to do this by giving them a tax benefit, which FedEx did, and then was lambasted in the press for not paying tax. So sometimes, I think primarily because of lack of understanding, corporate taxes can sometimes look a little bit bad in the press when in reality the company is doing what the government wants them to do. It looks like there's one more question. I probably have time for one or two more questions. This question comes from Mark Trockman. How do you think the corporate tax affects the distribution of wealth? Do employers have an incentive to share the wealth? Well, this, Mark, is a really great question. It's a really deep question, and it gets back to something that's been studied in economics for years and years and years, which is something known as tax incidence, which is the study of who bears the economic burden of a tax, not who pays the tax. And an easy way to think about this is when you go to the grocery store and buy something, there's a sales tax. And you, the consumer, bear the burden of that tax, but you do not send any tax to the government. The retailer collects the tax and sends it to the government. So it's a classic case of a retailer collecting the tax, but not bearing the economic burden. And the same thing happens with a corporation. A corporation pays the tax, but a corporation cannot bear the economic burden of the tax. It must be borne by a human. And the humans that are candidates are the shareholders, the workers, or the consumers. The shareholders might bear the tax because they might get a lower return on their investment. The consumers might bear the tax because the corporation might raise the price of the goods or services that they sell. And the workers might bear the tax because the corporation might pay the workers less than they would have paid had there been no taxes in place. The 50 years of economic research on this particular topic have yielded mixed results, but there is a consensus that the burden is shared among those three parties. What's at issue still, or what's not yet settled, is exactly what fraction of the burden is shared among the parties. So anytime we tax corporations, say, for example, we tax Walmart, we might think that we're taxing the wealthy Walton family, and we probably are to some extent. But we're also taxing the workers at Walmart to some extent, who now receive a wage slightly lower than they would have. And we're also taxing the people who shop at Walmart, who are paying a little bit more for the goods and services that Walmart provides. So I don't know that I can easily answer that question, but I can hopefully give you what I just did, which is a little more context with which to think about this. All right, one last question, and then I think it will be close to time to wrap up, which this comes from Vikas Chandra, who's an alumni. It says, what is your view on increase in the corporate tax to GDP growth? So I think what you're referring to is that as we have seen GDP growth stagnate a little bit in recent years, and corporate taxes have also declined in recent years, there's some who have suggested that GDP growth may not increase unless we can essentially have more government revenues. I'm not sure if I'm interpreting the question correctly. But let me just say that I do not believe, if you survey the economic literature, that there is consensus in the literature with regard to how the corporate tax affects something broad like GDP growth. When you think broadly about what's happening with something like the corporate tax, those taxes are used to provide goods and services which benefit our economy. But clearly, if it were taken to an extreme where all corporate profits were taxed, that would most likely have a detrimental effect. So I think in the long run, it probably makes sense for there to be some kind of business tax, if only for the simple reason that businesses are a efficient collection mechanism, but possibly for other reasons too. And the question really becomes how much or what rate should that corporate tax be, and how many nuances to the tax should we have? Should we tax every company the same, or should we give preferences to some companies that make investments which we believe are socially desirable, like things like green energy, or investing in machines, or research and development, et cetera? And that's a question which has not been resolved to my knowledge of the economics literature. Clearly, we could spend hours and hours, at least I could, talking about taxes. But I think this discussion might at least help you recognize the complicated nuances that might exist with any proposal that is made, or with any revisions to the existing tax code which might be made under either a second Trump administration or a first-term Biden administration. I think it'll be really fun to watch, and I look forward to seeing what happens. That's all I have for this session of LinkedIn Live. I want to remind you that these sessions of LinkedIn Live take place each Wednesday, 12:30. And the same will be true next Wednesday, where I hope you will take the time to log in and listen to the experts here at Fuqua talk about events that are happening in the world and are relevant to your life in the business world. Thanks again, and I look forward to hearing from you or seeing you soon.